Welcome back to the Global Wealth KPI YouTube channel and for week-by-week market update from 21st to the 24th of December 2020. Stocks were blended a week ago as speculators gauged administrators' endorsement of a hotly anticipated help bill against progressing infection concerns and new UK travel boycotts. Little cap and innovation stocks were up, with both the Russell 2000 and Nasdaq records completing the week higher. The US has proceeded with its inoculation exertion, with more than 1 million individuals accepting the main portion of the new antibody. The president has projected uncertainty over the entry of the new alleviation bill, yet we think it is probably going to pass since it contains key financing for antibody circulation. Purchaser certainty has seen a momentary plunge, and week-by-week jobless cases rose surprisingly, highlighting proceeded with strain from monetary limitations the nation over. A look back at an unprecedented year. The year 2020 will stand out forever as quite possibly the most important and eccentric long stretches of our lives. The pandemic and coming about well-being emergency overturned everybody, making extraordinary difficulties for people, organizations and governments. From a monetary business sector's point of view, 2020 was every time of phenomenal change yet possible versatility. As governments forced exacting lockdowns to purchase time for the medical services frameworks that were taken steps to be overpowered, the economy dove into a profound self-instigated downturn. Nonetheless, quick and forceful approach kept this well-being emergency from developing into a drawn-out, out-and-out monetary emergency. With 7 days left to go in the year, the light at end of the passage is more splendid because of the clinical discoveries around immunization improvement. Significant market lists are exchanging close to record highs, mirroring a positive 2021 standpoint, a result that was difficult to imagine during the beginning of the pandemic. While it is enticing to need to fail to remember this year, the difference in the schedule presents an occasion to reflect and survey a portion of the achievements of 2020. The land on this page isn't sufficient to catch all the amazing turns of events, yet underneath are 10 features, acceptable and terrible, that characterized the economy and the business sectors in the course of recent months, alongside the 5 contributing exercises they offer. From bull to bear to bull in a squint of an eye, the exceptional, abrupt downturn created the quickest bear market ever, with the S&P 500 declining 34% from unsurpassed highs in only 23 days. For point of view, recorded 35% decays took a normal of 11 months to materialize. On the flip side, the markets rising to new highs in August denoted the quickest recuperation from a bear market on record, emerging in only 4 months, contrasted and the authentic normal of somewhat more than 4 years. A week ago's 9-month commemoration since the March 23 base finds the S&P 500 65% higher and up 15% year-to-date. Record GDP swings. The U.S. economy encountered the most noticeably terrible quarterly constriction on record in the subsequent quarter, 31% annualized, multiple times bigger than the most noticeably awful quarter during the 08-09 monetary emergency. In contrast to most past downturns, the contracting of the economy was driven by a sharp decrease in buyer spending, as shoppers couldn't spend compelled. The ensuing resuming of the economy brought about the biggest ascent in yield in the second from last quarter, 33% annualized. These wild swings in GDP are an update that the U.S. is a help and shopper-driven economy, making patterns in the work market and family unit asset reports basic to screen. Joblessness spikes. By April, the quantity of laid-off and furloughed laborers rose to 22 million, eradicating all the net new openings made since March of 2091. Joblessness went from a 50-year low, 3.5%, in February to the most significant level since the Great Depression, 14.7%, outperforming the past high in 1921. From that point forward, with limitations somewhat lifted, we have seen strong improvement, with somewhat more than a large portion of the misfortunes being made back. Yet, the current joblessness rate stays raised. Taken care of to the salvage, a huge piece of the bounce back in monetary resources can be credited to the Federal Reserve's quick activities pointed toward giving liquidity and subsidizing to buyers and organizations. Early in the slump, the Fed rushed to drop strategy rates to zero and utilize its full scope of devices, including security purchasing programs, liquidity infusions, and credit offices. For setting, the Fed developed its accounting report by over $3 trillion throughout the span of 4 months, a comparable add-up to what in particular was added during the monetary emergency in 08-09 throughout the span of 4 years. 1. Utilizing Chairman Powell's words, the Fed is, not in any event, pondering raising rates, which emphatically proposes that rates and credit costs will remain low for at any rate several years, encouraging the extension and giving a screen to the market. Absolute bottom rates. On March 9, the yield on the benchmark 10-year Treasury quickly contacted a noteworthy low of 0.32% in overnight exchanging as speculators looked for the security of government bonds. Simultaneously, the 30-year Treasury yield dipped under the 1% edge without precedent for history. As national banks far and wide slice rates forcefully because of the emergency, negative yielding obligation arrived at a record of $18 trillion, further boosting the allure of stocks comparative with securities. As proposed, family units had the option to profit by the low financing cost climate. The normal rate on a 30-year fixed home loan dipped under 3%, giving property holders an opening to renegotiate their credits and giving a lift to the lodging market. Negative oil costs. Oil costs quickly fell into negative an area, $37 in April without precedent for history. This exceptional occasion was a consequence of specialized selling pressure before the Fates contract lapse, just as the restricted extra room welcomed on by the notable absence of interest. As capacity tanks topped off on the grounds that aircrafts and different purchasers were not utilizing as much oil as before the emergency, prospects contracts auctions off pointedly, as vendors were eager to take care of purchasers to take the oil their hands. Monetary guide overcomes any issues. With national banks having loaning powers and no spending powers, governments are bearing the weight of spanning the pay and business holes until the financial impacts of the pandemic blur. Congress passed the CARES demonstration in March, designating $2.2 trillion to organizations and customers as immediate installments to families, extended joblessness advantages, and credits to companies, independent ventures, and state and nearby governments. The lift to pay by government moves, alongside the powerlessness of buyers to spend during lockdowns, brought about an extraordinary flood in close-to-home reserve funds and an ascent in close-to-home pay. Financial help is relied upon to proceed to develop, and it presently represents 16% of GDP, the most elevated level since 1945. A, V, or K molded recuperation. Altogether, the economy bounced back strongly from its second quarter base. The unexpected idea of the downturn and repressed interest delivered a V-molded recuperation. Nonetheless, a more intensive look uncovers that the recuperation was lopsided across businesses just as segment gatherings. While certain ventures and areas, similar to innovation, profited by the pandemic, others, similar to carriers, lodgings and eateries, were lopsidedly affected. 66% of the employment misfortunes at the tallness of the downturn were in those weak ventures that depend on social contact. Likewise, private companies, which utilize generally 50% of the U.S. workforce, keep on battling. Authority originally limited, at that point augmented, up until the primary portion of the year market administration was getting extremely gathered at the top, as development-style speculations and innovation stocks profited by the stay-at-home patterns. By July, the biggest 5 stocks in the S&P 500, Microsoft, Apple, Amazon, Facebook and Google, represented about 23% of the record and were up 30% on normal by that point, versus the normal of the excess 495 stocks in the list, which were down about 10%. 1. Indications of a strong recuperation throughout the late spring months, and later sure immunization improvements, set off financial specialist premium in other resource classes, areas and venture styles. November was the greatest month on record for little-cap stocks, and upon the arrival of the Pfizer antibody declaration, a steam-style, profit-pay, speculations had their single greatest day over development-style ventures. 30 new all-times highs. The S&P 500 has logged 30 new record highs in 2020, 17 of them recorded after the late February pandemic-initiated bear market. Contributing lessons from 2020. Indeed, even in a year that tested the standard, a portion of our tried and true center contributing standards end up being a helpful guide in exploring vulnerability. The following are 5 key takeaways, exercises gained from the 2020 emergency. 1. Keeping a drawn-out viewpoint. Even in this curiously short however sharp downturn and bear market, adjusting choices to objectives for the long haul instead of features assisted speculators with keeping a level head. 2. The intensity of a trained methodology. Systematic contributing and rebalancing assisted financial specialists with exploring instability this year without having to time the market. The sharp auction in stocks caused the value bid of portfolios to be beneath the expected assignment weight. A 60/40ths value bond portfolio in February would have floated to a 50/50 weight blend by March. Managing overweight ventures and redistributing to underrepresented regions throughout the span of the year not just assisted speculators with boosting their value presentation at discouraged costs, yet additionally helped position portfolios for the new change in market administration towards monetarily delicate speculations. 3. Dread makes openings. The VIX, a proportion of market unpredictability frequently called the dread file, arrived at another record high in March, outperforming the levels seen during the Great Financial Crisis. While upsetting for speculators, outrageous instability has not verifiably gone on for an extremely lengthy timespan and has been trailed by solid forward returns. This additionally ended up being the case this time around, paying little heed to the novel trigger of the emergency. Times of unpredictable selling and constrained liquidation make long-haul occasions to purchase quality organizations at a generally lower cost. 4. Securities actually add portfolio esteem. Despite long-haul security yields floating close to record lows even before the pandemic-actuated bear market started, 10-year Treasury yield was at 1.5% in February. Securities actually showed their incentive in going about as a portfolio stabilizer. 5. Markets are forward-looking. The speed of progress in conditions this year featured the wide hole between the economy and the business sectors, helping us to remember the forward-looking nature of the business sectors. The 34% auction in February and March occurred when joblessness was close to 50-year lows, and the market decays reflected worries over the developing pandemic and the expectation of the subsequent downturn. However, at that point stocks revitalized in anticipation of a superior monetary climate in the second 50% of 2020, even as joblessness spiked. Heading into 2021, we anticipate ideally a year when the pandemic dies down, lives return nearer to ordinary, and the monetary recuperation gets steam. There will probably keep on being a lot of difficulties in the year ahead, yet as history and the current year's phenomenal occasions have shown us, adhering to one's venture plan can help financial specialists remain on target toward accomplishing their speculation objectives. That's for this week. We will see you with next week updates and thank you for watching. Subscribe this channel for more market updates.